본 방송에서 제공하는 투자 정보는 투자 판단에 대한 조언입니다. 방송에서 제공하는 주식의 가치, 가격 상승 및 가격 하락에 대해서는 방송사에서 보장하지 않습니다. 안녕하세요. 2022 3.1절 특집 월가 트레이더 버니의 진짜 미국 주식 진행의 도지은입니다. 코로나19 이후에 정말 어지러운 시장 속에서도 특히 이 미국 주식에 대한 인기는 여전히 커져가고 있는 모습인데요. 오늘 특히 이 월가 트레이더 버니 씨와 미국 증권 상황의 시장을 한번 짚어보면서 그 안에서 핫했던 종목들까지 한번 짚어보도록 하겠습니다. 미국 주식에 관심이 많은 우리 시청자분들은 꼭 시청해 주시기를 바랍니다. 본 방송에서 제공하는 정보는 투자 판단에 대한 조언일 뿐 해당 주식의 가치나 수익률을 보장하고 있지는 않고요. 또 서울경제TV, 서울경제신문은 당사의 브랜드입니다. 서울경제증권TV와는 무관하고 기타 유사 명칭에 주의해달라는 말씀까지 전해드리면서 그런 2022 3.1절 특집 월가 트레이더 버니의 진짜 미국 주식 지금 바로 시작합니다.
Well, what we've seen over the course of the last 6 months is the Fed adopting a stance that is more reflective of the fact that they want to raise interest rates because they believe that this transitory inflation that they initially thought they were going to have back in the first and second quarters of last year is now a little more sticky. Whether they have the right approach or not, or they believe it is not, time will tell when we find out down the road is it sticky or is it more transitory? I believe it's more transitory, and we will explain that later. But when we think about what the Fed's actions do, we have to think about that from the perspective of inflation. The Fed has two main goals. The first is maintain full employment, and the second is to maintain stable prices. Accelerating inflation is not necessarily stable prices. So what I've done right here is I've taken a look at the inflation-adjusted S&P and compared that to the rate of change of the consumer price index. The rate of change of the consumer price index is our best gauge for inflation. So I don't care what the inflation rate is today. And this chart, I compare where it was today versus where it was a year ago. So if the inflation rate today is 6.5%, which is we're a little bit above that right now, and the inflation rate a year ago was 1.5%, our rate of change over the course of the last year is 5%. So what I've done is I've drawn a 5% line that goes across this rate of change of the consumer price index over a 12-month period. Now, this goes back to 1947, and we can see that there are times that the market has gone above this 5% level, okay? And sometimes it's been a predictor or a forecaster of lower stock prices, and sometimes it's not been. So we have to watch and see how this goes. Now, the question becomes is where do we think this is going to go down the road? Is it going to continue higher here or start to roll back down? I believe it's going to start to roll back down, and we will talk about that a little bit later. Let's go to the next slide. So the last slide was an inflation-adjusted S&P. This is just straight S&P right here on the top clip, and the bottom clip is still, it's just a little bit cut off. It's blown up a little bit in terms of the time frame, but this is our same level right here where, in other words, we're not doing a rate of change. We're taking actually the price index and comparing it. And we can see that when the price index turns down, these are all these vertical lines right here. Okay, when the price index turns down, that's a positive for the stock market. So the fact that we can get a higher level of inflation and then inflation starts to go down, that's a positive for the stock market. And so what we want to see right here is we want to see a condition where either the price index goes higher or the price index starts to go down. If the price index starts to go down, we're going to go back into these occurrences that we've had here, which has been actual buy opportunities. Let's go to the next slide. So now the question becomes, what is the problem with inflation and how does it affect the markets? It's not the inflation rate that affects the markets. It's if the bond yields go up faster than the inflation rate, that's a negative. So what we've done right down here on this chart, this is the inflation adjusted S&P again, and down at the bottom, this is the inflation rate divided by bond yields, corporate bond yields, average corporate bond yields, not highest quality, not lowest quality, but average corporate bond yields. And so the average corporate bond yield is the denominator. If the average corporate bond yield goes higher, faster, that's going to send this below this measure right here, okay, this threshold line. And so what we found is that periods of time where the bond yields go up faster than inflation, that's been a negative, and it's all in pink. That's been a negative for the stock market. But you can see right here, we're still pretty far above that line. And there's no indication necessarily here that we're going to go back below that line. We can drift lower and go higher. That's not a problem. It's going below that line where the bond yields are going up faster than the inflation rate. Let's go to the next slide. So when we think about the inflation rate and all that and bond yields, what we really want to think about is, are we in a recession or are we not in a recession? So going back to 1947 again, our pink circles are occurrences of where we've been in recessions. The blue circles are where we've slowed growth down, but we didn't go into a recession. So let's say we grow at 3.5% or 4%, okay, and then we slide that growth rate down to about 0.75%. We never go negative, and then we start to go back up again. Those have been actual good buy opportunities as opposed to when we're in a recession and we really have to slow down. So what are we going to go through right now? We don't even know that we're going to have negative growth or a slowdown in growth. Currently, right now, we're forecasting earnings to grow at 8% for 2022. So we don't necessarily have any indication that we're going to go into either a recession or a growth slowdown. Let's go to the next slide. Now, this is where we're going to start to say, is inflation transitory or is it sticky? And this is why I believe it's going to be transitory. Our inflation rate came because supply and demand went out of balance. And the reason supply and demand went out of balance is not necessarily that demand slowed down or picked up, but that the supply was constrained because we were in COVID. We didn't have people working. We couldn't get semiconductor chips. We had problems across the board in a variety of instances. We couldn't fully staff meatpacking plants, so the price of beef went higher. Now, let's just think about this from the perspective of two things, okay? The first is a 2-year change in 10-year note yields. So where is 10-year notes versus where they were 2 years ago? We still are at really low levels of 10-year note yields. And where is the pink line right here is the prices paid component of the purchasing manager survey. That's where the purchasing managers around the United States basically come and present a composite prices paid number at the beginning of every month. And so we look at that. That's a great forecaster, and we'll show that in a minute. That's a great forecaster of where consumer prices are going to go. Well, right now, what we've seen is yields are going down, okay, compared to the last 2 years. Well, that has tended to lead the prices paid. So I anticipate prices paid to continue to go lower as long as these yields continue to go lower. And this is over a comparison to where we were 2 years ago. Knowing the data, this is not going to go higher in the near term. Let's go to the next chart. So we took that same prices paid, basically our pink line, okay, and then we're going to now compare it to the CPI index, okay, and we're going to lag it 6 months. We're going to move out the prices paid ahead of the consumer price index by 6 months. So we can say, where do we think that the consumer price index is going to be in 6 months? Well, we're pushing this out. And so I believe we're going to start to go lower in the consumer price index over the course of the next 6 months. Now, let's go to the next chart. I'm sorry it's a little blurry, but this is actually the prices paid component of the Purchasing Manager Survey, and we can see since early 2021 or mid 2021 till now how that prices paid component has been going lower. Let's go to the next chart. Okay, so in this case right here, what we found is that the consumer spending on goods last year, people bought things, they redid their houses, they purchased things. So we found that we had strong demand for goods, not services. When we look at services like restaurants and all that, they were shut down. So our service component slowed down, but the demand for the goods was stronger. We need to get those things back online to trend. Let's go to the next chart. We had imports hit a peak last November. And what I think, adjusted for inflation, what we found is that we have so much product, like at the ports, like the Long Beach, LA port, the Jacksonville port. We've got so much goods and services at the ports that as we offload those from those ports that are still backlogged a little bit, that's going to continue to reflect in growth. And when they sell those goods from those ports, we're not going to see it with substantially higher inflation, because now the product is actually into the system as opposed to the demand for the product without having the product in the system. Let's go to the next chart. So Cornerstone Economics, it's a economic consulting firm in the United States. They did a forecast, and what we see is year-to-year changes. Right now we're at 6.6% year-to-year change for headline CPI. First quarter they anticipate to be 6.1, but by the fourth quarter of next year they anticipate it to be 1.4. All the product inflation has been in the goods, less food and energy, and that's going to be negative in a year from now. The services inflation rate has been reasonably constant. So when we go back and we think about that very first chart that we looked at, and we get to 5% and we start to go back down, this is why I believe we're still going to start to go back down. Okay, so how does this impact the view of where we should be in the first quarter? Well, I'm really thinking about 6 to 9 months out, because what the Fed is doing is they're all concerned, and our media, our financial news media, is focusing on the hot button issues. Why we have inflation today, how big is it, what that's going to be. Well, what we really want to think about, because the stock market is forward looking. The stock market is thinking about where we're going to be out 6 to 9 months. So as we start to crystallize the view that I think we're going to have, that we're going to have very little inflation in 6 to 9 months, I believe that that stock market is going to start to reflect that. What we've seen currently is a transfer from growth stocks that we had in 2019, 20, and 21 and into more value stocks. Well, value stocks is a much more defensive game to play. And as people are selling stocks because they're worried about, they listen to the newspapers, they listen to the television, and they say, oh boy, we're going to have inflation, we should start to sell our stocks. once that stops, I think we're going to start to go better. We're still looking at 8% earnings growth for 2022. And if we have 8% earnings growth and we have very little inflation in 6 to 9 months, the stock market should be substantially higher. Will we be higher than here by the end of the first quarter? I think so. But I think our better opportunities for price appreciation in the stock market is probably going to be in the second, third, and fourth quarters. Well, right now, when we listen to the financial media, all we hear about is how the inflation rate now hasn't been this high since the 1980s, 40 years ago, late 1970s, early 1980s. Well, I think that's a very, very poor comparison. Sure, that is the same case. In other words, for about 40 years, we've had very, very little inflation compared to back then. But what we had back then versus what we have now are two totally different things. What we had back then was a labor force that was more in control, much more unionized, much more in control. We didn't have the productivity growth that we have now, and all of our computers and everything else that we do, our inventory management. So by not having inventory management in the 1970s, what we had are periods where inventories would build because unexpectedly they wouldn't be able to forecast. They'd have too much. They'd have to sell them out. Then when they sold them out, they didn't have anything back. We had people go on strikes, so much more. The steel workers strike, all that sort of stuff. On top of that, we really had a complete reliance on the Middle East for oil. Now oil is being found in the North Sea, it's being found up in Canada, it's being found so many other places around the world that we're not totally dependent on the Middle East for oil. I think a much better comparison to what we have now, which is a supply-constrained issue. And the supply-constrained issue was because of COVID. We didn't have the workers show up. We couldn't staff the meatpacking plants. We couldn't get our semiconductor chips manufactured and shipped. We had so many more supply-demand. We have so many more supply-demand issues now, not necessarily demand issues. I think what it's very much more comparable to is 1947, coming out of World War II, where we had same kind of thing. The supply couldn't match the demand, and so we had 20% inflation in 1947. But by the end of 1948, we had 1 or 2% inflation again. I think the similar things, the comparison is better for that than in the 1970s. In the 1970s, we had interest rates up at 12%. We were trying to really break the back of inflation. It was on a more permanent basis across all products. We have no increase in services inflation. It's all in goods and raw materials, that sort of thing right now. The inflation rate in services has been constant for the past 2 to 4 years. So there's no big change there. So when we think about this, we can't really compare this to what happened in 1979 and 1980. Paul Volcker raised interest rates to 20%. We were targeting money supply back then. The Fed doesn't target money supply. Its two jobs is to maintain full employment and stable prices. Well, they're no better a predictor of prices 6 to 9 months down the road than any of us are. So what we'll find, I believe, is in 6 to 9 months, our price problem in terms of prices of goods is not going to be the same kind of inflation-based change that we've had right now. When we also think about and we listen to the commentary in the financial media, and then we listen to some people that are saying the stock market's going down 10% this year. Well, everybody's entitled to an opinion. A year ago, Morgan Stanley said the stock market was going down 10%, and it went up 23%. That's a pretty big miss. We look at where we think earnings growth is going to be for 2022, and right now earnings growth looks very, very good. It's going to grow at about 8%. When we think about the fact that we've had three consecutive years of double-digit, greater than 10% stock market returns for 3 years in a row, what's happened in year 4? Well, in year 4, stock prices appreciate somewhere between 6 and 9%. So I believe by the end of the year, we're probably going to have a stock market that's up somewhere between 6 to 9%. I'm not any better than anybody else in terms of anticipating that, but if I just think about earnings growth and the quality of earnings, and as we come out of Omicron and be able to start opening up the economy even further and further again, I think that our earnings growth of 8% is an easy target. When we think about the health of the stock market, what we want to look at are a couple of different things. We want to understand which sectors are showing the best growth, okay, right now, which sectors are performing the best. And when we look at those sectors, how is the profitability of those sectors? And then we also want to look at, and we've talked about this several times before, we talked about it in July and August when we said that the internals of the stock market, the smaller stocks were underperforming relative to the top tier stocks. We then talked about it again in late November. And what I want to do is show what's happened during those periods. So when we look at the sector performance right now, this chart current here is a reflection of all of the different sectors in the market. And we can see that the energy sector is the strongest performer this year so far, followed by the financial sector. Every other sector is down on a year. The worst performing sector is information technology. Now, when we go to the second chart and we look at this, this compares where we've been for all those sectors going back 4 or 5 years. So when we look at the sector that's done the best, information technology. When we look at the sector that's done the worst, it's energy. And so what we know is the market is driven by the most profitable sectors in the market, okay, and the best revenue growth. And the best revenue growth over the last few years has been in information technology, in software and hardware. It has not been in energy. Energy is more of a defensive play as opposed to a growth play. Right now, what we've seen is a lot of people selling growth over the course of the last, say, 2.5 months and buying value. Well, that's great, but that's a very defensive play. And once they're into value and the stock market starts to go up, they underperform. And that's what happens. That's why most people underperform the market, is because they're not in the best growth areas in the market as a whole. They're in the more of the Procter & Gamble names, the Exxon names, different names like that, where that growth is pretty steady all the time. We sell only so much soap a year. We, believe it or not, sell so much gasoline a year. But when you look at information technology, all of a sudden that growth is explosive. So let's go to the next chart. Now, this chart, this is a reflection now of when I talk about the internals and the stocks that aren't performing. This chart right here compares for the last year the percentage of stocks that are above their 200-day moving average in the NASDAQ. Okay, and we can see that sometime in late September, we went from above 70% of the stocks basically above their 200-day moving average to now below 70%. These stocks are above their 200-day moving average. If the market's going to turn healthy, it's got to get back above here. We saw a great rally in early October, and that came from this move right up here. But we never got back into the same space that we were in before. for the stock market to really do well, we've got to get this line back up. And I think things kind of come and go, so I believe we're going to go back up at some point in time. Right now, we're down here because we're absorbing all these selling by people that don't necessarily want to hold the growth stocks currently. So once they're done selling, I think we're going to see, because we've seen some pretty depressed prices, we're going to start to see this line go back up above here, and I'm going to monitor for that. Let's go to the next slide. So we've talked about the advanced decline line before on the NASDAQ and how it differs when we look at the entire 2,500 stock basket of the NASDAQ stocks, and we don't just look at the NASDAQ 100. And we can see the health of the stocks that are basically, let's say, mid-tier. There's always some stocks in the NASDAQ index that really shouldn't be in there. They're just not big enough. They're not strong enough. They eventually wind up getting kicked out and replaced. But the center core is important to us. When we talked originally in June and July, I said that this advanced decline line was underperforming, and I just didn't know if we were going to be able to monitor and stay up here. We wound up having a sell-off. That line started to flatline out, and this was that October rally that we just talked about. Okay, but since mid-November, we've had a marked decline in this, and we may have that decline for a couple of reasons. We may have had that decline because people were tax selling because they're concerned about interest, our tax rates going up in 2022. They could be taking profits. They could have purchased stocks at a price that probably didn't support 3 to 5 year earnings growth and stock price appreciation. Say, for example, Bill.com, which went from $100 to $400. And if you bought it at $300 or $330 and that stock is now trading $280, you're concerned. And then that stock trades $250, you wind up selling. And so what we've seen is growth stocks being sold to buy value stocks. And maybe I think a lot of it is an overly concerned focus on anticipatory Fed moves and what that implication is. Just because the Fed raises interest rates doesn't mean that the market goes down. What we have to see is bond yields go up faster than the inflation rate, and we're nowhere near those levels. Let's go to the next chart. So this chart right here takes that same advanced decline line that we looked at over the course of the last year and looks at it over the last 20. So we know we've seen a complete erosion in the middle tier of the NASDAQ stocks. Well, where does that erosion fit relative to where it's been in the past? These circles right down here, 2009, 2013, 2016, late 18, early 2020, and current. These are all the spots where we had a low in that advanced decline line on a composite basis. And you can see that once we started turning up from every one of those spots, we had a significant rally. So the question becomes is, where are we going to turn up from, and how soon is that going to be? Is it going to be in the first quarter? Is it going to be in the second quarter? And I think we're just going to have to monitor to wait and see what that happens. But I do believe that we've absorbed a lot of selling over the course of the last 6 weeks. Let's go to the next chart. Now, this is the same chart we've talked about also before, the number of new highs versus new lows. A healthy stock market makes as many a little bit more new highs than new lows. New 52-week highs versus new 52-week lows for each stock. So when we think about all the stocks in the basket, how many of them are making new 52-week highs today versus how many of them are making new 52-week lows today? And we can see that most of last year, we were hanging above zero on this thing. So we were making more 52-week highs than 52-week lows. But look at what happened in mid-November to late November, once we hit this market up here, we started making substantially now more 52-week lows relative to 52-week highs. Once again, we need this thing to go back above zero. We need the market to try to make new 52-week highs versus do 52-week lows. This is going to take a minute to occur because if we're just making a new 52-week low, it's going to be hard to go back up and make a new 52-week high. But we want to be monitoring this because this is going to be how we found great attractive prices. Let's go to the next chart. So let's look at that same chart, same that I do before, over the last 5 years and say, where have we set our bottoms in, okay? Back in late 18, we set our bottom right here and the market bounced off. This was a seminal event. This was the COVID onset in early 2020, and I think that's a once-in-a-generation buy opportunity. So that number became so deep, and now we're back in here to where we found these same levels. We want, obviously, this to bounce back up again, but you can see sometimes it goes up pretty quickly. So we're at a place now where it's an interesting spot, and what we need to do now is to monitor this for the anticipatory move back up so that we're making more 52-week highs versus 52-week lows. This is one of the reasons why I think the market is set up to be able to provide some kind of buying opportunity going forward. And don't forget, we're still thinking about 8% earnings growth for this year. It's a positive environment for earnings. And I think once we get rid of Omicron, that we're going to start to see the economy open up more and more. So previous to this, we've talked about the composite market as a whole and how the health of the market is, which sectors are doing better, which sectors are underperforming. Then we also looked at the internals of the market, and we could see that there was an erosion in the midsection of the stocks in the NASDAQ 2500 composite list. And that erosion, we've had that erosion twice this year, June, July into August, and then basically October, late October into current. And what I want to do now is also reflect, we've looked at about 30 stocks currently and how those stocks are doing. For example, we talked about Bill.com when it was about $110, $115. That stock ran up to $400, and now it's back down to around $180, $185. These are the things that we want to think about is like, what's the health of the stocks that we've looked at so far? And what I want to show you is how those stocks have eroded, just like the market internals, but where I think these things are going to go. Over the course of a 3 to 5 year window, I think these stocks are going to significantly outperform. These are, generally speaking, growth stocks in industries that are going to grow substantially between now and 3 to 5 years out from now. They're all well-managed companies, and the founders or the CEO owns a substantial amount of those stocks on so many of these different stocks. But what I want to do really fast and just quick, is look at these stocks and give you a flavor for what's going on. Then I want to show you how those stocks have looked when I put them together and I say, okay, how many of these stocks are growing faster than the market's stock price performance? So remember, every time I talk about a stock, I compare it to the NASDAQ composite, and what we want to find is we want to have a portfolio of 15 to 25 stocks that are outperforming the NASDAQ composite. If most of our stocks are outperforming, the market's going to do great and we're going to do great. If most of our stocks are not outperforming at the current time, that's where we're going to see confirmation of that erosion in the market that we've talked about. Now, over 3 to 5 years, I think all these stocks, I don't say all of them, but I think many of these stocks are going to do great. We will add more stocks into this basket. This is a growth basket because what we're trying to say is in the information technology sector, amongst other sectors, the networking sector, the networking hardware, we're going to find great growth. That growth is going to occur because of metaverse. That growth is going to occur because of the networking environment that we're going to see, the way we store data, the way we manage data. Our productivity now is so much better than our productivity in previous decades. When we looked at the 1970s, our productivity is nowhere near where it is now. This is great productivity, and we can thank the computers and everything else we do because of that. Just-in-time inventory management, all sorts of new technology, that sort of thing. So let's take our quick look and compare how many of these stocks currently are outperforming the NASDAQ composite. The first stock is Bill.com. So we can see right now Bill.com, and I took my little moving average. We looked at this stock here, and we bought that stock. This is all compared against the NASDAQ, so it's not the stock price. But we can see that from when we looked at it to right now, that stock is still outperforming the NASDAQ, but it's underperformed the NASDAQ over this last, say, 2 months. So let's go to the next chart. The next chart is Microsoft. Same thing, we're starting to underperform. Next chart. Amazon, we've underperformed all year, but we know Amazon's a very good company. Next chart. Upstart. Upstart did explosively well. It's come back. Next chart. DocuSign, same thing. It did well, and then it started to come back again substantially. Next chart. Netflix. We recommended it right around here. It got up, it came back. Now Netflix, we're still above the cost of where we talked about it, but it's now just the same market performer since we looked at it versus when we talked about it. Now the difference is that we had the great appreciation and now it's underperformed. Next chart. IDEX, same thing. Strong outperformance, underperformance. Next chart. Chewy, underperformance. Next chart. AMN. Basically, it outperformed. It had a significant move down, but it's kind of recovered from there. Basically, a market performer right now relative to the last 80 days. Next chart. Fiverr, underperformed. Next chart. Arista, ANET. Significant outperformance. The chairman owns $5 billion worth of that stock. Next chart. The Trade Desk is trying to outperform again. Next chart. Tesla continues to outperform. Next chart. CrowdStrike underperformed since mid-November. Next chart. Zscaler, significant outperformance. It's underperformed lately. Next chart. Shopify. Shopify did okay. It hasn't been substantial. Its earlier moves were great here. It's underperformed over the last month and a half. Next chart. Unity Software. Big outperformance, now underperformed. Next chart. Facebook, okay, underperformed since late September, early October. Next chart. Starbucks, underperformed pretty much all year. Next chart. Roblox. Big outperformance, kind of comebacks, trying to do better. Next chart. Snowflake, big outperformance, now it's starting to underperform again. Next chart. Akami, it's starting to outperform again. Google, great outperformance, now it's underperforming. Next chart. Apple, great outperformance. Next chart. Lucid, still strong outperformance. Next chart. Disney, underperformed all year since April. Hasbro, starting to outperform. So, one more chart maybe? Yeah. Boeing Aircraft, starting to outperform. But Boeing Aircraft is a more defensive stock. Next chart. NVIDIA, outperformance all year. Next chart. So, we went through 29 stocks. My point is that how many of these stocks, these are all quality stocks, how many of these stocks are outperforming the market? And the way I measured it is, how does it look at the end of the month? How many of those 29 stocks are outperforming the market? And we can see that early in the year we did great, then we started to come back up. This is our 50% line. We were above 50%, but now look at, we spent 3 months below and we've just continued to erode. So we want this line to get back above 50. If we think about this, if we have picked good stocks, which all of these stocks are, once we absorb the selling and they start to rotate higher, I look for this percentage to start to move back up. So is this a better buy opportunity or a sell opportunity? I think down here, it's a better buy opportunity. 80% of the years the stock market goes higher. On average, the stock market goes up 9% a year. We've had 3 consecutive years of double digits. When we have had 3 consecutive years of double-digit growth, the 4th year has been higher. Not as much, single-digit growth, 6 to 9%. So all of these situations laid together, 8% earnings growth this year. I think what we're going to have is once we wind through this selling, hopefully sometime in the first quarter, we should start to see a move back. So many of these stocks that we've looked at will start to outperform, and it's a question of staying on them and monitoring these stocks. This is the same kind of thing that we think about with quality growth stocks that we looked at when we looked at the NASDAQ composite, and we could see those internals. So this has confirmed the internals the same way that it did before. Better buy opportunity down the road. Would you rather sell stocks down 10% or buy stocks down 10%? If you buy stocks down 10%, much better situation than if you sell stocks down 10%. When we looked at the market 2 weeks ago, we could identify that the continuation of the weakness in the internals was still going on. And what I'd like to do today is provide an update to that. When we think about the market this year so far, it's acknowledged that this is the worst January we've ever had. Sometimes it's very difficult to predict the bottoms of the stock market. We know that the stock market returns about 9% a year on average. Well, very rarely does it ever return 9% or 8% or 10%. It either returns 20% or 30%, or it loses 10% or 20%, sometimes even worse. But in the course of the whole period, it returns on average 9%. So the way that you basically earn that 9% is you have to be able to withstand some of this volatility that we're having. We're in a period right now of pretty significant volatility. And one of the reasons that the volatility is so significant, on top of the fact that we don't necessarily know where we are with COVID, but we also have a Fed that we've now, some people are anticipating 7 interest rate hikes in the course of 2022. I don't believe we're going to have 7 interest rate hikes in the course of 2022. So many times the Fed has been more hawkish or more concerned about inflation at the beginning of an interest rate cycle, rate hike cycle, and it never goes to the extent it does because it's the market and the economy slow down, the stock market sells off, and they don't want to be the cause of a liquidity event. So let's take a look at where we are now versus where we've been 2 weeks ago. We're going to look at the advanced decline line. We're going to look at the number of new highs, new lows in the NASDAQ as a proxy for the health of the market. So right here, we can see that, and this chart right here is the last 20 years, okay, of the advanced decline line. And we can see that in 2008, when we were breaking down fairly significantly, our advanced decline line now is much, much lower. Well, why is that? Well, what we have right now is a very, very low funds rate, a very, very low 10-year note yield, and the technology stocks, they are the biggest earners over time, and they're also the most volatile, and they're the component, the growth component, if we think about value stocks and growth stocks. Over the last 20 years, growth stocks have significantly outperformed value stocks. And over the next 10 years, I'm sure that growth stocks are going to significantly outperform value stocks. But what happens with growth stocks is you're anticipating this big growth in earnings farther and farther out than you are with value stocks, where you have a much more consistent earnings yield and a return. So when you change interest rates, you have a much bigger effect on the growth stocks earnings than you do on the value stock earnings. And that's why this decline right here is so much more significant than we've had before, because we're doing this from a relatively low interest rate cycle right now. So we're worried about how high up they could go. I still believe that we are at the peak level of concern about inflation today. And in 6 to 9 months, that concern, let's go 9 months. In 9 months, that concern is going to be much less than where we are right now. In fact, I don't believe we're going to have much inflation at all in 9 months, because we're going to alleviate the supply chain concerns. And we've already looked last week at Purchasing Managers Index and how it's a proxy for inflation going out 6 months. So let's go to the next chart that we have. This is what we saw 2 weeks ago, okay? And what we saw right here is we saw a decline in the new highs and new lows in the end of 2018. And then we had the COVID, and now we were down here. So we can see that we were not at that peak level of COVID, but we were back to the level that we were at the end of 2018. Now, if we flip forward to the next chart, we can now see this is just blown up. This was the end of this was the beginning of COVID right here, and right here we're down to that same level in the new highs, new lows that we were in March of 2020. So much lower than where we were 2 weeks ago. So now what we have is a condition where we've seen the equivalent amount of selling that we had in 2020, in March of 2020.
네, 월가 트레이더 버니의 진짜 미국 주식 통해서 미국 증권 상황과 그리고 종목에 대한 이야기까지 전달해드렸습니다. 여러분들 주식 투자하시는데 도움이 되셨기를 바랍니다. 또 본 방송에서 제공해드린 정보는 투자 판단에 대한 조언일 뿐 해당 주식의 가치나 수익률을 보장하고 있지는 않고요. 또 서울경제TV, 서울경제신문은 당사의 브랜드입니다. 서울경제증권TV와는 무관하고 기타 유사 명칭에 주의해달라는 말씀까지 전달해드리면서요. 저는 여기서 인사드리겠습니다. 시청해주신 여러분 고맙습니다.
본 방송에서 제공하는 투자 정보는 투자 판단에 대한 조언입니다. 방송에서 제공하는 주식의 가치, 가격 상승 및 가격 하락에 대해서는 방송사에서 보장하지 않습니다.